Good evening, everyone. A very warm welcome to yet another interesting episode of the Fisdom Wealthcast. And like always, we have yet another interesting guest with us. Today with us, we have Vetri Subramaniam. He is the Group President and the Head of Equities for UTI Mutual Fund. A very warm welcome, Vetri, to the Fisdom Wealthcast.
Thanks, Nirav. Delighted to be here this Friday evening with you and all your viewers.
Thanks a lot. I'm really looking forward to this conversation. There are just so many questions that I've been personally noting down, and I've been meaning to ask you since quite some time. So I'm glad that we are having this conversation. So without any further ado, there is I personally love picking the topics that are most popular among investor forums. These investor forums, they have these whispers and questions that keep going around in circles, but no one really addresses them. And the most pertinent question of them at this point in time is that, is the market turning a blind eye to the state of the economy? Is there a dichotomy between the state of the economy and the way the markets are going, the broader indices are performing? Are we just being too happy for nothing? Or is there some underlying sentiment that the market is reflecting? So the question in short is, do you see a divergence in the way markets are performing versus the economy? If yes, why? If not, why?
Sure. No, that's a good question, Nirav, and it's a question that I get asked quite often. And I wish people had the ability to sort of tune out of markets for a long period of time. Because what I tell most people is that if you had gone on a holiday on 31st December last year, or even let's say February 29th, 2020, you had gone on a holiday and you had come back in August of 2020, you would have looked at the market and said, not much has happened. I left February 29th, now it's August 30th, the market is up 2%. It's been a pretty boring year. Now, the only reason that people are experiencing these extreme emotions in terms of trying to understand the market is that first the market collapsed more than 30%, and then from that low it's come back almost about 60 odd percent. So the main reason why people are really feeling this disconnect is because of this fact that the price first went down and then it rebounded so dramatically. If you had been sleeping this entire year, you would have come around today to this Fisdom show and said, what's the big deal? Your market's up 10-12% for the year. Okay, it looks like another boring year. So it's really the price action which is causing this doubt. Let's look at the next issue. How is the economy doing? Is the economy doing well? Is it doing poorly? Here again, unfortunately, and we are also to blame. We all talk about the economy, we talk about GDP. Now, obviously, people are reacting by saying, "Oh my God, in the April to June quarter, GDP was, minus 24% or whatever that number was, and this is a disaster." But I think we need to understand, GDP is a measure of production. If you ask people to sit at home and to not consume, and you tell the other people don't go to work and don't produce, of course GDP will collapse. Where's the mystery in that? The point is that that quarter is not reflective of a normal economy and the normal functioning of an economy in which people go out to work and to produce goods and services, and other people are consuming that even while remaining producers of other goods and services. So that is a very incorrect period to use as an interpretation of, is the economy doing well or is the economy doing poorly? Second point, and I think here again it is an interesting sort of evolution to look at. Nirav, one of the things which has been happening in India, and I would say this has been particularly pronounced from 2015, is really the fact that India is continuously formalizing. And this process has been pushed through by various, sort of reforms brought by government, as well as changes that are happening in the way the country operates. If you think back to demonetization in 2016, you then look at the introduction of goods and services taxes in 2017, where people were forced to come into the tax net, become part of the formal economy, pay their due share of taxes. both indirect and direct, because now you can't hide from the system anymore. Then you got a credit crisis in 2018, and this was particularly acute in the NBFC side, which meant that credit flow to the economy actually suffered, and particularly smaller enterprises and informal enterprises were more severely affected. Then you come to COVID, where you go through this lockdown, and once again, it's the small, informal businesses which are feeling the impact much more than larger organized sector businesses. So we have gone through this period of 4 or 5 years continuously where the economy has experienced certain challenges, and there is a different distribution of the gains in the economy. Those gains are increasingly flowing to organized sector companies, and by definition, organized sector companies are listed companies because all listed companies operate in the organized sector. Now, when you look at the numbers for the organized sector or the listed companies, a very interesting pattern which shows up when you look particularly at this results of the September quarter gone by is that obviously production was starting to normalize through the quarter. So revenues for the Nifty 50 companies were negative year on year. But because they were dealing with lesser competition, because some smaller enterprises were struggling to get back on their feet, b many of them had disproportionate cost savings. Profits for the Nifty 50 companies actually went up by 17%. So you have to realize that the reality that the Nifty 50 index reflects is the reality of those 50 large companies. If you look at the Nifty 500, it reflects the outcome for the top 500 companies. So we are in an economy which is without doubt operating at two speeds. The formal sector is growing well, the unorganized sector is suffering, but the stock market reflects the gains which are accruing to the organized sector companies. And I mean all organized sector companies, not just the top 50, because this pattern is visible even if you go to the top 100, top 200, or top 500 companies for that matter. So are there problem sectors in the economy, Nirav? I think the answer is clearly yes. We know that there are certain sectors which are still struggling because of COVID. We know that the informal, unorganized, urban services oriented areas are still experiencing challenges, but there are other companies which are bouncing back. There are other industries which are gaining momentum. Anything which is export facing, anything which is rural economy driven are actually bouncing back very fast because agriculture is having a good year, and therefore you are on a twin track economy. The economy by most parameters is sort of back to normalcy compared to the levels of a year ago. So when you think about it from that perspective, the economy is back to where it was a year ago. The market is up 10-12%. Again, as I said, nothing exceptional about this year. Is just because of COVID, a dramatic collapse and then a dramatic recovery. People are experiencing, this very strange disconnect between what's happened and how the markets have behaved.
Right. I feel that was a very well elaborated perspective on the situation, which brings me to a more pertinent question at this point in time. And, it couldn't be asked to anyone else other than you at this point in time. It is around small caps. So UTI Mutual Fund has launched its NFO on UTI Small Cap Fund. So the first question, now is a time where we have, there has never been a time before wherein the perspective on the valuation of small caps were as diverse as it is today. Everyone has a different opinion, and always people have different opinions, but the variety is so wide today that it begs the question, why launch a small cap fund now? Wouldn't it be a better thing to wait and wait till things slightly settle down, or there's some glint of larger broader based recovery, or what was your thought behind launching the small cap fund right now at this juncture?
Sure, sure. No, that's again a interesting question, Nirav, and I must say there is a combination of many things that went into the launch happening today. First is the fact that we actually evaluated the opportunity to launch a small cap fund actually 2 years ago, and at that point we felt it was not appropriate for a variety of reasons, including the valuations in that space and the recent, I would say 3-year, 5-year track record that small caps had delivered. We then actually filed our offer document for the small cap fund more than a year ago. We would have been ready to launch if not for COVID. And when COVID happened, our priority was first to just make sure that normal operations for the company could continue, employees were able to make sure that everything was in order, and that was our first priority. And then, of course, UTI was going through its own listing process, so we decided to hold it back by another 3 months. So I think the earliest we could have brought this to the market was perhaps in the June to September quarter, but because of the IPO, we decided to push it into the fourth quarter of the year. But I don't think too much has really changed for us to say that today is not a good time to look at small caps. And let me elaborate on, therefore, why I'm saying I think the small cap fund is still a relevant and a attractive investment opportunity to look at. First, let's look at the valuations. When you look at the Nifty small cap index on a price to book basis, it's actually still trading in the fair value territory. And the reason I'm emphasizing price to book is that because of this pandemic, we've actually stopped looking at the price to earnings because that is distorted by the impact of the lockdown. Your first normal year of earnings is actually FY22. And therefore, the price to book is a better indicator of where you are in a historical context. Interestingly, the Nifty 50, which is the large cap index, has now entered expensive territory on a price to book basis. But the Nifty small cap is still in the fair value zone. So, first, I would say valuations still make an attractive case for small caps on a price to book basis. Is it as cheap as March of 2020? The answer is no. It's obviously March 2020 was bargain basement cheap. But at that point of time, you, me, and everybody else were just focused on one thing: how do we get by? How do we survive? Right? Today, things have changed 6 to 8 months later. But we still think valuations are fair based on the fact that it's in fair value. The second indicator from a valuation perspective, which is still favorable for the small cap index, is that the dividend yield on the small cap index actually still remains in the attractive zone. Unlike the Nifty 50, where the rally has actually brought the dividend yield down to closer to historical lows, in the Nifty small cap, the dividend yield still remains attractive. So I would say point number one, there is a reasonable level of comfort with valuations. The only reason people look at the market and look at small caps and say, is it overextended, is because you're looking at the rally from the low. Just change your perspective and look at what has been the return outcome on small caps over a 3-year basis. It's negative. The index is negative on a 3-year basis. So I would just say, look at that. The valuations are giving you comfort. There's no point looking at the bounce of the last 6 months. On a 3-year basis, small caps have done nothing. In fact, they are negative. The next point that I would really make over here when it comes to small caps is, let's look historically, right? Historically, when do you see small caps start to do well? They typically do much better when money has become cheap, right? And money starts to flow into the economy again, simply because of supportive fiscal policies and supportive monetary policies. We have already gone through the crisis. The outcome of the COVID crisis is extremely supportive fiscal policy and extremely supportive monetary policy. Not only has the RBI cut rates uh, with sovereign support, it has backstopped lending to large cross sections of the economy. This is the ideal condition in terms of looking at strong cycles of performance for small cap stocks. So when I combine these two parameters, the valuations along with, as I said, the favorable starting conditions, which means you've already gone through a crisis and all your parameters are set at supportive levels. Fiscal is supportive, monetary is supportive, government is looking for policies to push growth, central bank is saying, I want to push growth. That's the best opportunity to look at small caps. One final point I will make here, Nirav, because people do ask me the question that if you are saying formalization, does it mean that the large will benefit disproportionately? Only the Nifty 50 companies will gain, small cap companies will not gain? Fair question. The point remains that even when we look at these companies in the Nifty small cap index, they are organized sector companies. And in many cases, I would say they benefit even more when smaller companies go out of business because they these smaller, unorganized, informal companies are a bigger threat to small organized sector companies than they are to large organized sector companies. So the formalization trend, in fact, I believe, once again creates a very supportive environment for these small caps. And we can talk about this later, Nirav, perhaps, but I would also remind you that when thinking about small caps, mid caps, and large caps, we should keep in mind that there is a difference between sectors in which large caps, mid caps, and small caps compete with each other. And there are sectors in which, by definition, the market leader itself is a small cap company because it's a small industry. But the operating characteristics of that company resemble the superior operating characteristics of a market leader in a large cap category. So the thought process should be of leaders and smaller companies or not leaders. Leaders, whether they are mid, small, or large, actually enjoy the same set of benefits.
Right, right. Perfectly put. In fact, I am still carrying a point that you mentioned towards the beginning of this response, and you spoke about how the past 6 months would be a great bounce, but over a longer period, small caps haven't really shown much returns. For a 3-year period, the returns are almost negative. um, my personal observation, even I've noticed that the BSC small cap TRI 250 is in the past 3 months it has returned close to 50%, but ironically in the past 5 years it has returned only 7%. I've heard investors tell me this, but I want to hear your perspective on it. So investors always they joke about this thing that small caps favor the bold and not the disciplined. Do you really think that's the case? Because we always suggest whenever anyone wants to invest in the small cap category, it is recommended, highly advisable to stay in for a longer duration. But then when we look at the historical returns, it seems like it is more about timing than discipline. The people who stayed invested for 3 months made 50% returns, and the ones waiting since 5 years only get 7% of a CAGR. So, what's your comment on this situation, and what do you think should be an investor's perspective when it comes to viewing small cap returns in the short term and in the long term?
So very perceptive question. Let's look at it in two ways, right? One is let's understand the kind of return differentials between, let's say, large cap companies, mid cap companies, and small cap companies. Just to simplify it, we look at those three indices. Two things become very clear. When things are good, the small caps do significantly better. Equally, when things are bad, small caps do significantly worse. Right? If I were to convert this into a statistical measure, whether you're looking at 1 year, 3 year, or 5 year rolling returns, the outcome that you get is that the risk adjusted return of large caps is actually very decent. The risk adjusted returns of small caps are actually adverse, right? So, in a way, the data set at the first glance is telling you that if you want better risk adjusted returns, remember we are talking about adjusted for risk, we are not talking about the absolute return. When we look at that, the data is telling you that large caps are better than small caps. However, what the data does not tell you is that if you are able to manage the risk parameters well, the ability to enhance the alpha from stock picking is a lot larger in small cap funds than it is in a large cap fund, right? So that is the opportunity and why you should look at small cap investing. If, as you rightly said, Nirav, if somebody is so good in terms of timing, he knows when to buy small caps, he knows when to sell small caps, perfect. You time it and perhaps you will do well. Full credit to you. I've spent 25 years, I cannot figure out how to time these things. But what is your alternate strategy? The alternate strategy is to depend on the ability of the fund manager, the team, and the investment process to create a disproportionate alpha. What is alpha? Alpha is nothing but by how much am I able to beat the benchmark. Now, because stock picking makes such a big difference in small caps as compared to large caps, the potential alpha that you can get in small caps is far superior to what you can get in the large caps. In large caps, you are competing in 100 stocks with a strong bunch of sophisticated investors. In small caps, you're competing in almost 300, 400 companies with less investors really understanding or investing in them. So this is where the return metrics then start to improve in your favor, subject to the fact that you have a good fund manager, you have a good investment team, and you have a good investment process. And I think what we really bring to the table at UTI to this whole domain of small caps, we've not had an offering so far in this space, is the fact that we have a strong investment process. What does that process do? It really enables us to ensure that we don't pick the bad stocks, right? When you pick bad stocks in the large cap category, the impact cost of getting out of the stock is limited. In the small cap category, every mistake you make will get magnified in terms of the damage it does to your returns. Our process helps us stick to a better selection of stocks. The second thing which works to our advantage is really the investment team. Right? We have a large investment team. We cover almost about 200 and as on date 215 mid and small cap companies. But by this month end, because we timed our expansion and coverage with the launch of the fund, we'll be closer to 240 to 45 companies. So our internal research analysts are on top of these companies, and our fund managers have the experience of picking winning ideas and losing money in bad ideas, right? But that experience is valuable because I always say paying tuition fees once is fine, but paying tuition fees twice for the same lesson, that's a disaster. And I think the experienced team along with a strong process allows us to reduce mistakes. The companies with which we operate therefore are the companies from which it is more likely that we spot some winners. The other thing that we genuinely believe in the small cap strategy is that we would like to run a diversified portfolio, because that is the only way to manage the risk related to smaller companies. So what are the risks in smaller companies? Typically they could have a geographical concentration. Small cap companies have a challenge that it is difficult for them to attract top quality managerial talent, right? I mean, if somebody is given the opportunity to join, for argument's sake, Hindustan Unilever, and compared to that you are asked to join a 200 crore company which is in create selling personal goods, obviously Hindustan Unilever has a better ability to attract talent. So they typically lack in managerial talent as well. The other challenge they face is access to capital, access to credit. All of these are challenges for small cap companies. But that is where our investment process, along with the very clear thought process that we will run a diversified portfolio, 70 stocks in the portfolio, top 10 stocks, not more but than 30%. Not because we don't have conviction, we have conviction. But what we also know is that the cost of going wrong in size in the small cap is very difficult to recover from. So I think when you take this 360-degree perspective, the investment process, the team, the position sizing, the continuous review, you get an outcome where we can create superior alpha. So yes, to go back to your original question, risk adjusted returns when you look at the small cap index are worse than the large cap index. But this is an important but. With the right fund management process, the scope for alpha is correspondingly higher in small caps. When you adjust for that, you can actually get a superior outcome in a small cap fund. So, which is why we believe there is space, but look at it as a strategic fit, not from a timing angle.
Right. Now, given that you have shared so much yet so little around the investment process, it is driving me crazy, being inquisitive about what your actual investment process is. I remember sometime back, I've had the conversation with the UTI team, and there was something called as core alpha, which is a name that you have given to the methodology. And I faintly remember that the methodology was something that really was interesting. It had a few interesting facets. So while you have obviously elaborated on how important an investment process is to derive success out of small cap investments, I would really request you to share what is UTI Mutual Fund's investment process all about. If you could perhaps just open it up and flesh it out for all of us, I feel it would clear most of the doubts we have, and help most investors who are still doubtful to see and understand an investment process into small cap funds with much more clarity than with what they already do.
Sure. Let me just give you an insight into that. So, when we say score alpha, it's actually a rearranged acronym because it basically stands for two things. One is the fact that the two fundamental pillars of our investing process, one is operating cash flow, right? So, let's say OCF, the other is return on capital. So, we basically combine OCF with ROC and we rechristened it as score. And alpha is our target, right? That is what we want to beat the benchmark. I'm very clear. As fund managers, it is neither my job to predict what the market will do, nor is it to try and ride cycles in the market. Our target is alpha. If the market goes up, we want to do slightly better. If the market comes down, we want to do slightly better. Slightly better when it comes down, meaning fall less than the market. That's how you create alpha. You do not create alpha by riding the waves in the market. That creates only beta. So we are very clear. Our target is alpha. That's point number one. Then what are those two fundamental pillars? The two fundamental pillars, and people in the stock market are obsessed with profit, correct? But what you must understand, and anybody who has any accounting background or has run his own business will understand that a business can have profits, but the profits are not equal to cash which is getting generated by the business. So our first fundamental pillar is that profits are good, but operating cash flow is even better. Why is it better? Because operating cash flow is the fuel for the business. It allows you to operate the business without excessive reliance on equity holders for capital or banks for credit support. Secondly, it is only when you have operating cash flow that you will eventually also have what we call free cash flow. Free cash flow is the cash available to you to reinvest and grow your business, right? No business can grow if it does not reinvest. So the critical conditionality is that profits are good, cash is better, and if you have cash, it gives you the option to reinvest in your business, which can then create wealth for you. That's the first pillar. What's the second pillar? The second pillar is that it is not good enough to just invest in your business. The return on the capital that you invest in your business must be higher than the cost of capital, right? If the return on capital in your business is less than the cost of capital, you are destroying value every day just by running the business, right? So these are actually two fundamental pillars which have nothing to do with the stock market, Nirav. Tomorrow, if you, me, or any listener on this call were to run his own business, you would run it by these principles. Am I generating cash out of my business, which can help me pay my employees, keep my house running? And is that capital earning me a return better than what I could get in my bank? If I'm not, I might as well shut the business and leave my money in a fixed deposit. So these are principles of business. All that we do is apply these principles of good business in investing by saying that what we really emphasize is the ability of companies to convert profits into cash, reinvest those cash to grow the business, and reinvest it at a rate of return which is higher than the cost of capital. So these are the two primary pillars on which any analyst in UTI evaluates companies. And when we evaluate these companies, we look at least the previous 5-year data, and then we give the company a rating based on these two metrics. So this creates, so to speak, the alphabet soup based on which fund managers can then create a portfolio. They know what is this company's rating on return on capital, what is its rating on operating cash flow, and that becomes an input for them to choose whether to put it into their portfolios. Companies that we think fail on some of these metrics or corporate governance metrics, they are removed from the universe. So no fund manager can touch them, either because the metrics are poor or because governance is poor. Uh, we also recognize sometimes, Nira, that companies can go through challenges. They could have a difficult year in terms of return on capital. Some businesses are inherently cyclical. They will have some good years, where you are sort of fasting, and then you will have some good years where you are feasting, right? In that context, what becomes important to us is not the single point ROC, but is there a scope for return on capital to improve? So this is how we built the entire architecture of why we are looking at a company, why are we investing in it, and what is our belief in terms of what can happen in the future, right? What's the growth opportunity? What is the possibility that return on capital can improve from a depressed level to a better level? And it is this architecture and these sort of alphabets that go into then creating the portfolio. So I would really say that what the investment process does, the score alpha, is that it makes sure that we stay away from weak companies. We invest in stronger companies that can create value for investors. And finally, what it also does is that it gives us a way to manage the risk within the portfolio.
Hello. Hello, Vetri. Can you hear me?
Yeah, okay. Yeah, I can hear you. I think I lost you there for a second.
Yeah. I'm so sorry. I'm unsure what happened, but yeah, I lost the connection. Okay. Yeah, so sorry. You were saying something and we just lost in between.
Yeah, no, so I was just concluding on that point to say that therefore what score alpha does is really it gives us a grammar. It gives us a grammar of what does each company stand for, what are we looking for from that company in the future, and how those companies can fit into our portfolio. When we talk about our small cap fund, what we say is that we are looking for businesses which are scalable, right? Our first thing is
Right.
not valuations. We want to buy businesses that can grow in size, scale, and profitability over time. That's how they will create value for us, right? So
Right.
that's our primary criterion. That is best done in companies which have strong cash flows and high return on capital. Within that subsegment, we may have about 30 to 35% of our portfolios, which loosely speaking, the market would call turnaround companies or transformational opportunities, where either cash flow or return on capital is currently suppressed or depressed, but we have a set of reasons why we believe this return on capital might improve in the future, or there could be a transformation in the way that the industry operates, or a transformation specific to a company because maybe management is changing, the thought process is changing, which can cause return on capital to go up. And therefore, that again fits into our investment universe. So I would say our portfolio is sort of a blend of 70% growth orientation and 35% value orientation in turnarounds and transformation. But see, as fund managers, the challenge is that then these become abstract themes. The beauty of having a process is that we can connect this back to the data. We connect it back to how much of our portfolio is invested in high return on capital companies, how much is in low return of capital companies. And these are all the metrics that we use on a regular basis to monitor and stay disciplined about the way we manage the portfolio.
Right. Absolutely. I feel that was a lovely elaboration. And as we move towards the fag end of the session, I would request that, my comment section is being flooded by a number of comments. We would love for you to answer a couple of them. So let me just handpick one of the most popular questions. So, okay, I have received at least 4 questions around this theme. So I'm just going to summarize it and ask it as a single question. Uh, the bottom line is now a good time to book profits?
No, so let's be very clear about this. I think unfortunately people are always stuck in this timing game. And what I always tell people is that eventually you need to invest with certain goals in mind. To achieve those goals, you need to have some sort of discipline about asset allocation. And that could be a targeted asset allocation and a range within which you will allow your asset allocation to go. And the times for increasing asset allocation by putting money into equity or withdrawing money from equity by putting it into whatever else, whether it is debt or gold or whatever it is, has to come from some model. And let's say the best model for that, in my opinion, is valuations. When you look at it from that perspective, I would say two things here, Nirav. One is, I think the great opportunity to increase allocation to equity, without doubt, was in March this year. I think the previous similar time that we saw was somewhere in 2012, 2013. Prior to that, similar low for the price to book multiple was somewhere in 2009. Today, you are at elevated levels on price to book of the Nifty. So I would say that is a signal that you should not really be enhancing your allocations to equity anymore. If anything, you may even have to correct it because the rally has perhaps caused your equity allocation to go above the normal threshold you would want to. So there is perhaps a case to manage your asset allocation better and reduce equity. However, within that equity basket, I would still say that these signals are supportive for small caps and mid caps for the reasons I mentioned earlier. One, valuations, uh, where they are in the cycle, negative returns for 2 to 3 years, and finally, the opportunity created by the fact that the macro environment is very favorable for these small cap and mid cap companies. So I still think there is a case to enhance over there, but the signal for increasing asset allocation to equity today, it is certainly not a positive signal. If anything, it is a watch your asset allocation and go back to your base level of allocation to equity.
Right, right. So the next question is an interesting one. So I'm just trying to reframe it because it's in bits and pieces. So the question is more about when you are going to manage your small cap fund, do you intend to maintain any certain sectoral overweights, or is it going to be purely a derivative of the stock picking?
Very good question. So Ankit Agarwal is our fund manager for the small cap fund. He already runs our mid cap fund. And what we've always articulated, Nirav, both for the mid cap fund and for the small cap fund, is that in these strategies, what is important is stock picking. And therefore, it is the bottom up stock picking which really drives the portfolio construction. The only reason we would look at sectoral allocation is really to understand the risk dimensions of the portfolio. Are we getting very highly exposed to one sector or underexposed? Is that raising our active share, which is a measure of risk relative to the benchmark? It's also a measure of positive risk relative to the benchmark. But so we would look at sector allocation only from a risk management perspective. The portfolio creation is frankly done on a bottom up basis. If anybody has seen our presentation on the fund launch, we have given what our current model portfolio for the small cap fund is, which shows some overweights in areas like financials, pharmaceuticals. The biggest overweight is actually in consumer goods. But I would say those could change over time. The primary focus is on bottom up stock picking, and it is on picking those stocks which, as I said earlier, could be small cap, but they are leaders in the industry or sub industry where they operate.
Right, right. Very perfectly put. I feel this was a question that needed to be answered. Most often people wonder how small cap funds are actually run, and we have received quite a number of queries about what we think that UTI Mutual Fund would be doing with the small cap fund. So it's great that you answered it yourself. So it brings us to the next question. Just a moment, I noted it. Yeah. So the next question is a rather simplistic one, but I feel it's an interesting one in in favor of the audience. So how long is long term when investing in small caps?
Good question. And I would say, honestly, any investing has to be at least 5 years plus. Honestly, it doesn't matter large cap, mid cap, small cap. I would be quite comfortable even in small caps with a 5 year plus horizon. I also want to move the grammar of investing away from this definition of long term. I think what each of us has to recognize, given where average life expectancy is in India, that if you're 25 years old and starting today, you've actually got a 40-year career ahead of you to think about. So, why are you obsessed with the definition of what is long term? Is it 3 year or 5 year? You've got to plan for how will I manage the next 40 years. And honestly, I've just turned 50 this year, but I would say even for me, 20 years is perhaps, just based on life expectancy numbers, that's the average that I should be looking forward to. And 20 years is a very long period of time. So I think we need to change this grammar away from what is long term. Unfortunately, not true anymore, Nirav, but and maybe your older audience would be aware of this. I used to find till about 10 years ago that everybody defined long term as more than 1 year. Why? Because that was the definition of long term capital gains tax. Right. So, because long term capital gains tax is for holdings more than 1 year, which was, of course, zero for many years. So, people used to associate anything more than 1 year means long term. That is a government definition. That has nothing to do with investing. So, and now, of course, it's 3 years, you get a tax break. But again, I would say that is a tax definition. It has nothing to do with life. When you think about your life, you need to think in 10-year, 20-year, 30-year buckets. So don't obsessively focus on that. But if you look at cycles, and I think that's a good point, the typical cycle in mid caps, small caps tends to be about, I would say, 5 years to 7 years. So yeah, that's a time frame you could certainly look
Right. So I feel, we should move away from, asking what is long term to asking what is a long enough term,
at.
for us.
Exactly.
And right. So very well put. I really love the perspective on this. So as we move towards the end, there's one last question that we would pick, and I couldn't go without picking this question because, you slightly touched upon it, and it is something that lingers around all investors' mind. It is around risk. So the question is, are small caps the riskiest assets? Is it fair to view it from this perspective? So basically, the question is more about, people trying to be risk averse and think that, small caps are just too risky and not for a retail average investor to play. So the question is around the right perception or the right perspective to look at risk when it comes to small caps.
So let's put it this way, Nirav. If you're going to go out in the market and individually buy stocks, without doubt, the riskiest segment you could go to buy those individual stocks would be the small cap space. But today, what we are discussing is not you going out there and buying a small cap stock, but you investing in a small cap fund. The minute you do that, you have already taken care of one risk. You are now buying a diversified portfolio. You're not buying a single company anymore. Secondly, in our approach, as I said, we are actually looking for those companies which, those who remember their high school chemistry, the word we use is isotopes, right? Because isotopes have the same characteristics as the other molecules, but they have less electrons, right? So that is why we are looking for those kinds of companies which automatically reduce risk. Then when we run with a 70 company portfolio where we don't allow anything to get concentrated, we have put another layer of risk management on top of it. Along with that, you put the process, you put the team, you put the discipline of review. That is how we think the risk can get managed. So maybe a repeat of what I said earlier, but yes, there are risks in small caps. Mortality rates in small caps can be high because company can uh, go out of business. They don't have access to capital. Promoter transition to the next generation may or may not be successful. They find it difficult to get professional talent. But that is what my job as a fund manager is. So I would say, leave it to us to be able to handle these risks. We have the toolkit to handle those risks.
Absolutely. I feel it's a rather succinct way to, put all doubts to bed, pertaining to risk. I feel as long as we
So
are not
just
trying to,
one last point to make over there. This is a comment which has been made by others, but I think it is relevant to all investing, right? A ship is very safe when it is in the harbor, but that is not what the ship is designed for, right? It
right,
is designed to go into the high seas. It will experience challenges. We cannot refuse to go because there are no challenges. Otherwise, what's the point of having a ship which is anchored? We must have the toolkit to manage the risk, and that is why you are
right.
coming to us as an organization, and that is our fundamental offering.
Right, right. In fact, I just want to share this one comment. It's not a question, but it's a really sweet comment that UTI is the oldest MF. We believe and have trust in whatever UTI MF will do. So it's not a question, but I feel it was a very sweet comment by one of our viewers. It is a reinstatement that all of us are here in the business of trust and faith more than money, right? And UTIMF being among the oldest organizations has a really strong credibility that it has on the line each time, and every single day it manages every single rupee of the investors, and we really know and acknowledge that the team there is cognizant of the responsibility of the fiduciary responsibility on its shoulders, right? Vetri, it has been a lovely conversation. I feel we picked very pertinent pointers. There were very important doubts that needed to be addressed, and that were addressed very well. The UTI Mutual Fund is having its small cap NFO, ongoing as we speak, and there are investors expressing interest and having more questions about it. So, guys, for the audience, I know you are having more questions, but in case of any queries that we were unable to answer due to the paucity of time, please feel free to write to research@fisdom.com. The team here will try to help you out with it. If there are questions very pertinent to the fund and from pertinent to the expectations that you have from UTI Mutual Fund, we'll try and reach out to Vetri's team at UTI, but we'll try to address everything that you need to ask. So, Vetri, getting back, I feel it was a lovely conversation. I personally enjoyed having this entire talk with you. Thanks a lot for taking out the time today on a Friday evening. It has been, a great experience talking to you and learning from you.
Great. Thank you so much, Nirav. It's been a delight having this conversation with you. I hope all the viewers find it useful. And, we are coming up to the end of the calendar year. So I'd just like to wish everybody a wonderful 2021. Let's hope for much better health, prosperity, and, good peace everywhere. Thank you.
Absolutely. Thank you, Vetri. It's been a pleasure.
Thank you.
So, guys, this was Vetri Subramaniam. He's the group president and the head of equities for UTI Mutual Fund, which is one of the oldest mutual fund houses in India. And if any of you skipped any part of it or were not paying attention, I'm just going to give you a quick recap of the key takeaways. UTI Mutual Fund has an ongoing NFO, the UTI Small Cap Fund. The small cap category is typically riskier than other categories. It is, but what, it gets all the more riskier when you try to venture into it on your own. But fund houses and institutions like UTI Mutual Fund, whenever they launch a fund, they, like in the words of Vetri, they have the toolkit to manage the risk. So, by virtue of investing in a small cap fund and not investing in small cap stocks directly, I personally believe you have already hedged a large portion of the risk by entering a diversified portfolio, by putting your money into a portfolio that's managed by experts, by investing in your money with an institution that has a lot of institutional depth and domain expertise. So if you want to invest into small caps, if your asset allocation allows for it, a small cap fund will always be a better choice than a small cap stock, unless you are very sure about what you're doing. Apart from that, one needs to understand that it is risk adjusted returns that matters. It is, returns in isolation mean nothing. Risk in isolation means nothing. uh, Risk adjusted returns mean everything when it comes to investing. So have your eyes on that. And also do not really get disturbed by the chaos or the noise on the street. There, social media, mainstream media, all of them may be flooded with a variety of opinions. Today, even as we speak, even we may have our own opinions, but what really matters to you is your financial goal, your asset allocation, and your discipline. As long as you are sticking to it in the right way for the right period, I think you're good to go. So you need not really react to every piece of information that comes your way. So, guys, that's it for the day. As always, the more you share, the more you learn, the more you learn, the more you'll earn. So do not forget to share this video with your loved ones. Do not forget to like and subscribe to the channel. Very soon we will be back with yet another interesting guest on another interesting episode of the Fisdom Wealthcast. Meanwhile, keep investing, stay invested, and keep making money, guys. Happy investing. Have a good day.